to our May Market AGECO update. Today we're going to have three presentations. John Robinson, first, he's going to talk about cotton markets. Mark Welch, he's going to talk about grains. And David Anderson, who is going to talk about livestock markets. So, John, whenever you start.
All right. Can you see a presentation?
I can see the presentation. Yes, you may want to click the X. Yeah.
Is that good?
No, I still look at.
All right. So we need to flip.
Slideshow.
Yeah, slideshow.
And go to the left from beginning.
From beginning. Do what? I'm in it from my perspective, Pancho.
Okay, let's do it then. I cannot. I don't know why I cannot see them. I don't know everybody else. Maybe they may have something different, but I can't.
Okay. Well, I'll just talk.
Yes.
Let's see if I can break.
Let's keep moving. You know.
I'll see if I can break two computers in one morning. All right. Cotton prices are still low. They're at the bottom of a year-long trading range, which has been downward. I can explain the old crop price weakness with by comparing the outcomes of ending stocks for this marketing year versus the previous one. The ending stocks are higher. They're 4.8 million compared to a little over 3 million. That's fundamentally bearish, where we have more leftovers compared to the previous year, and prices don't have to be as high. So fundamentally, that explains some of the weakness. Probably doesn't explain the degree of the weakness. I would attribute some of the extreme nature of the price decline. I would attribute to short selling by speculators, which I'm showing in a chart here. We're at record levels still of speculative short selling. That means that people that make money on trends have been betting on a downtrend, and they're still betting on a downtrend. So that's ongoing. Now they could get scared if some bullish news came along. If we're talking about the old crop, the old crop is pretty much finished. The supply question has been answered, so we know what we're working with. So the only bullish thing that could come along would be trade related, demand related. The economy would pick up. The administration would settle all the tariff disputes. I'm not sure if or when that's going to happen. So these people that are being negative Nellies and betting that the market's going to go down, they're still holding on to those positions. So we'll just have to see how long they continue to hold on to them. In terms of fundamental news, probably the most important thing to look at is this the chart of weekly exports, which is shown in the slide that I'm displaying. Weekly exports have been they've been so-so to weak. Most of them have been under 300,000 bales a week. That's pretty modest. Some of them have been under 200,000 bales, which is downright bearishly, disappointingly weak. You know, why are export sales so low? Well, this is U.S. export sales. So one of the reasons is Brazil's been selling and out competing us. So the people that have been buying up all the available Brazilian and Australian. That's one reason. And there is that I think there's just kind of general negative consumer sentiment, uncertainty about the economy, uncertainty about people feeling how much they should be spending on durable things like clothing. Maybe we should put off those kinds of purchases. I think that kind of an effect is impacting the cotton market. And I wanted to talk specifically about tariffs because I've gotten a number of questions about, well, how is the tariff thing impacting cotton? And my answer to that is it's impacting cotton indirectly. There's not, at the moment, we have these huge tariffs that were suspended for 90 days that were applied to a number of important trading partners, including Vietnam and Bangladesh and Indonesia, places like that. So we're kind of in a position of negotiation, eventual hopeful negotiation with those countries. We also have huge tariffs on China, which have been suspended for 90 days down to more minimal. I think we have a 10% tariff against Chinese or no, it's higher than that, 20 or 30, but they have a 10% tariff on us, which would in theory affect our exports of cotton to them, except for one thing, and that is if you look at if you can see the chart I'm displaying and look at the far right-hand side of it, we haven't sold much cotton to China this year, and that's not because of tariffs, that's because of Brazilian competition and just other reasons. There's not a large volume of U.S. cotton to be impacted by the imposition of a tariff because we just haven't sold much cotton to them. So there's really no direct impact, not much of a direct impact of tariffs or threats of tariffs, at least on China. Where the tariff thing is potentially affecting the cotton market is indirectly, and that is that if these tariffs go into effect, if they stay in place, that's tariffs broadly, tariffs against Mexico, China, Europe, other trading partners. If those go into effect, that most economic studies that I've seen would project that has a drag on economic growth. Tariffs reduce GDP, and anything that reduces economic growth, that reduces GDP, is generally bad for cotton demand and cotton consumption, because what you're basically saying is when times are bad economically, people cut back on the things they can cut back on, and that would include spending their disposable income on apparel and towels and sheets and things that are semi-durable, discretionary household items. Generally, those get put off when economic times are tough. And so if these tariff caution it's like a wet blanket on the general economy, to the extent that happens, then that could slow the demand for cotton. And that may be going on, and that may be why those speculators are betting that the market's going to be down, because they're looking at the kind of the consumer sentiment, the negative consumer sentiment, and the caution of people that would buy cotton. So those are my thoughts about tariffs. The old crop situation is winding up, then we're probably more focused and more interested on the new crop situation. So let's take a look at that. Right now, we've got a guesstimate of planted acres, and all the supply and demand forecasts are being driven off USDA's March 31 planted acres number. Now that number is going to get updated on June the 30th. And it could historically, it could be 5, 6, 7% higher in June compared to what they measured in March. So the possibility of the crop getting bigger or smaller is there, and the market's going to be making guesses, and people will be placing bets which way they think, if the market's supply is going to get tighter or supply is going to get heavier. But right at the moment, just looking, USDA is taking that March 31 planted acres number, and they're looking at the drought monitor, and that monitor looks pretty bad if you're in El Paso or if you're in Uvalde. But if you're in the rolling plains, if you're in the northern Blacklands, if you're in the southern plains around Lubbock, if you're in the Panhandle, this ain't so bad. This is better than years past. And so USDA is assuming a little bit less abandonment, a little bit more of what's planted will get harvested. They're baking that into their supply and demand projections, and they're guessing an average yield or maybe a little better than average yield. And so as a result of that, from an economist standpoint, is they're betting on a little bit more supply, pretty close to last year, but a little bit more. and they're being pretty, I would say, bold in their forecast of new crop exports at bumping it up over 1 million bales compared to the previous year. I hope that comes true, but I think they're being just sort of bold while they can. And even with that, they're penciling out higher ending stocks, 5.2 million compared to 4.8. So a 500,000 bale increase in ending stocks for the new crop balance sheet. That's not very good in terms of projecting higher prices. I would project the same to lower. I would project some price weakness with that. So if you take a normal seasonal index, which is what this shows, with the index being 0 to 1, and 1 is the highest prices of the year that normally happen in June, with the market outlook and the ending stocks outlook that I've just penciled, or that USDA has penciled in, it may not, the high there in June may not be, but the mid 70s. We might be lucky to get to like 75 or so before the normal harvest time seasonal lows kick in, and that would probably take us back into the mid 60s or so. So price outlook for the new crop situation is not looking very good unless we get a surprising cut in planted acres, which we won't know till June. So we'll just have to see. Pancho, with that, I'll stop and answer any questions anybody might have real quick. Otherwise, I'll try to be on the line. Not having much luck.
Thank you, John. Hey, any questions for John? Well, Mark, are you still there?
Oh, here's your John. Say, Pancho, do you want to go grains next?
Yes, please.
Okay, good. All right. Hang on just a second. We will see if we can find the right formula for doing that. Let's see. Let's share. Here we go. And hopefully we are getting there. The slideshow from the beginning. Hope you can see all that okay.
We can see that, yes.
All right, we'll get rolling there. We're going to touch a lot of the same, things that John just talked about with the cotton market, the update from the May WASDE with the first projections from USDA, but again, how all these factors kind of interact and shift and move together to determine or reveal, discover, the grain price over time, near term, with wrapping up the 24 crop as well as projections for 2025, and so we'll kind of look at how some of that interplays and kind of where I think we're headed for prices here for this new crop corn. First of all, looking at the WASDE report, the top part of that table, not too many surprises. Back in March, U.S. farmers told us they were going to plant 95 million acres of corn, and so USDA plugged that number in. One thing that's a little bit surprising is that USDA not only plugged in a record high yield of 181 bushels, which that's not a surprise. They've been talking about that yield since last November. But the percent of crop that's harvested relative to planted is higher this year than last year. And so that bumps up that harvested acreage a little bit more than just the increase in planted acreage does. So those things combined to give us an all-time record high production estimate, record high supply. And again, no surprises there. We've seen this coming for a long time. What was a little more encouraging out of that May WASDE were projected higher levels of domestic use, particularly on feed. And I'll be anxious to hear, David's comments around, livestock sector and poultry to support the increase of grain for feed for the new marketing year. And that's a pretty good export number. We'll put that in perspective here in just a minute. But that USDA raised their export projection again in the midst of all the turmoil and uncertainty and tariffs back and forth. For USDA to project that kind of number is pretty optimistic. I think it pretty bullish for the corn market. So we've got an increase in supply of 3.5%, 4%, but use is also up, which offsets some of the price depressing impact of a bigger supply. 1.8 billion bushels of carryover, days of use on hand from a 34-day supply to a 42, which is kind of where we were, in the 23 crop. But prices lower, a step lower again for 2025, down to about 420 a bushel is USDA's outlook, given all those supply and demand numbers. Looking at those use categories, again, this is the May WASDE, updated with the 25-26 marketing year, and that uptick in feed use, that's a pretty strong number in this biofuel era. To have 5.9 billion bushels of feed use, that's pretty strong, especially if you look at what's happening with livestock numbers. That's a pretty strong increase in feed use. Fuel, basically steady, no really growth on that aspect. But then come down here to exports, and that would be the second highest level of exports on record here for U.S. corn. So again, with all the turmoil going on in that world, to see that kind of number, I think is pretty optimistic for our use numbers. And the price impact of taking that carryover, again, from a 33, 34-day carryover in 2024. Now let's push that out to a 42-day carryover for the 25 crop. Pushes us over that 40-day threshold, which we've talked about many times is very critical in the corn market. So in this $4, $4.25 range would kind of seem reasonable if that carryover holds, given those supply and demand numbers. And so that's kind of some of the projections we'll be looking at, how likely those are to change over time. Can we hit that yield? If you just look at a straight trend line yield, and that chart goes back to 1950, a straight line yield projection for 2025 would actually be something over 183 bushels per acre. But what USDA did, it looks like, is they took that average rate of growth over that period of time. We're growing at about 1.92 bushels per year. So just under a 2 bushel growth for the last 75 years when it comes to corn yields. If you take last year's 179 bushel yield, add trend line growth to it, you come out at 181. So kind of an average crop. Does that make sense? Yeah, probably does in this world. But there's some resources, I think, that can help us and perhaps provide some insight into the likelihood or how are we going to track to hit a record yield. And I want to talk about those very briefly here this morning. Of course, the one I think we're all familiar with is every Thursday morning when the drought monitor comes out. We all check that status, and you can check how that changed from week to week, year to year. You can put in different dates, different regions of the country. I'm focusing on the Corn Belt. This is the North Central region, and I'm comparing the May 6th drought monitor to the May 13th drought monitor, the one that came out last Thursday. And there are some areas of concern. If you look at the areas that are abnormally dry and moderate drought, this yellow and this kind of tan color, it's expanding somewhat over northern Indiana and northern Illinois into southern Wisconsin, a little bit across southern Iowa, northern Missouri, and some key corn growing areas. But then you get over here in Nebraska, this is starting to raise some significant levels of concern, not only going from moderate, now there's an increasing level of severe drought. And then the one that really becomes worrisome is when you get into these red and these almost dark brown colors, the extreme drought and exceptional drought condition. Those are the ones that really have an impact on crop production. And even though it's early, and we were just getting a crop planted here in that part of the world, you can see these counties that are now rated in extreme drought in northeastern Nebraska beginning to expand compared to a week ago. Don't grow a lot of corn out here in the far western region of the Dakotas or Nebraska either. But you get over here along the Red River Valley and into the eastern half of Nebraska, we're talking about major corn production. So to see that kind of trend is not positive if you're looking at something to impact the U.S. corn yield for the 2025 crop. There's some other resources, and I want to talk on these very, very briefly. This is from the Iowa Environmental Mesonet, IEM. And if you want details on this stuff, let me know. I'll be glad to forward them to you. This resource tracks, in the particular map or charts I'm showing you, track growing degree days. And this is a measure, are we warmer or cooler this growing season than normal. Accumulated precipitation, again, relative to what would be normal, and I've tracked on here what we're doing so far this year compared to a year ago. And then there's a measure called stress degree days. When that growing degree base, the number of degree days above this 86 degree threshold, when that starts to create some stress, particularly when you're growing corn, this will start to take some of that top yield potential off the crop. Is that starting to show up in our weather monitors? So first of all, growing degree days, the black line in each of these charts is normal, or what they call climatology or average. I've got the 24 crop in green, the 25 crop in red, and I started on April 1st, and this is through this morning's report. As we were a year ago, we're running a little bit warmer than normal through April and May, getting the crop planted and off to a start. Not severe, but you can see that starting, that accumulation of growing degree days above normal is starting to build a little bit. So we're running a little warmer than you would in a normal kind of spring. If you look at precipitation, again, the black line is normal. The green line, we were looking at some near record levels of precipitation in this region a year ago, and it hasn't rained for 2 weeks. It's pretty well shut off. And then combine above normal temperatures with the fact that it hasn't rained in a couple of weeks, now we're seeing these stress degree indicators starting to kick up. And I didn't mention what region we're focusing on with this particular chart. This is the Southeast Climate Division in Iowa. This is the geographic center of the U.S. Corn Belt. And so I like to start here to kind of see what's going on. And of course, there'll be different conditions across a wide range of states that involve the Corn Belt. But what's happening right in the heart of the U.S. corn growing regions? And it's warmer than normal. And we've had a dry period, which may help get the crop planted, but you certainly want to see that extend for too long before you start having some drought impacts. What about that area of Nebraska we were just talking about? The Northeast Climate Division in Nebraska, very, very similar, except that a year ago, they were about normal in terms of growing degree days. Now we're seeing the heat start to accumulate in that particular growing region there in Nebraska. So our growing degree days are accumulating well above normal. Much that we were seeing in Iowa is that it was pretty wet a year ago. It really hasn't rained much over the last several weeks in this part of Nebraska. In fact, we've been below normal since the middle of April. So this dry condition has extended for considerably longer in that particular area. And the stress degree days, again, that combination of it's been dry for a good period, and now we're starting to add some heat to those dry conditions, and those stress degree measures start to kick up. What does Texas look like? This is the South Central Climate Division in Texas. As we were a year ago, we're running warmer than normal through this April and May period. Our precipitation, however, is held pretty close to kind of normal numbers a year ago and here in 2025. Now, we've gone now a week or 10 days since our last good rainfall across this region. And again, as we're seeing in those other maps, if you combine the rain shuts off and the temperature continues to build, that can start to accumulate these stress degree days. So again, we're starting to impact perhaps yield potential on our central Texas corn crop. So again, just some resources out there that I think kind of help us monitor, are we staying on track for that record yield, which is a big part of the supply and demand balance sheet from USDA. And so prices. Typically, we're in the time of year, the seasonal pattern, we would hit the high of that December corn crop about the middle of June before we know we got planting it, we got the crop in, we kind of know a weather forecast, pretty good handle on acres, and then we've seen a fall off in prices. We look like we may have set that high at this point, maybe set it a little early, unless we get a weather problem, unless something changes on those demand pictures, particularly around trade. I think as Dr. Robinson mentioned, if we were to settle some of that uncertainty, I think that would be beneficial for our commodity markets in general. But at this point, it looks like we're settling in to more of a post-peak price pattern if you're looking at what's happening on that December futures contract. We'll touch on wheat just real briefly, and then we'll wrap this up. The supply and demand conditions on wheat, very little change, very small increase in supply, not from a bigger crop. In fact, crop's likely to be smaller this year because we're planting fewer acres, but we've got more carryover. So that's creating a little bigger supply situation. And the use numbers for U.S. wheat, just flat. Nothing on the domestic front. In fact, a lower level of wheat exports projected by USDA. That pushes the carryover in wheat from 155-day carryover to 172. That's not a good move. Pushes prices lower, a 550 season average farm price to 530. And the updated reference price for wheat for this 25 crop is 556. So we're starting about earning a significant PLC payment when it comes to the 2025 wheat crop. And again, pushing that carryover to that 172-day supply puts us kind of back in that poor price territory of 2015, 16, 17, 18, 19. You know, these weren't great times for wheat prices, and we're kind of pushing back into that category. Crop conditions look like they're getting better week to week. We'll get another update on that this afternoon at 3 o'clock. But after the last couple of weeks, the crop index for the U.S. winter wheat crop is getting better. USDA is expecting a U.S. winter wheat yield, 53.7 bushels per acre. That's better than just a trend line estimate for the winter wheat crop. Would be about 51 bushels. So again, I think that's one factor that's weighing on our wheat prices, as it does look like this U.S. crop is coming in a little better shape. If you look at global wheat competitors, of course, the U.S. only produces about 6% of the world wheat crop. So what's going on in the rest of the world? Well, current projections for 2025 would be for increased projections in the top four. The big four producers, look at China, Europe, a big rebound this year, another record crop in India, Russia coming back a little bit. Again, that's putting pressure on that global wheat supply, but it's not done yet. There are some areas of concern. This is a weather map, and this resource is called GeoGlam. They come out with this crop monitor at the end of every month. At the end of April, they were showing significantly dry conditions. There's Germany, Poland, the Czech Republic, across Ukraine into Turkey, central Russia. There's quite a bit of this Eastern European area that's dry. And so if it stays dry, if it happens to get hot as that wheat crop is finishing, there may be some potential to turn this wheat market around if that were to carry out. Again, that's just an area of concern. And I like the way they present this information based on how big you are in terms of global production, how much of your area is in these particular categories of exceptional, favorable, a watch category, poor conditions. You know, what are we looking at? About a quarter of the European crop, maybe a quarter to a third of Russia's wheat crop. They're showing still some concern in the U.S. and the Great Plains states where we've been dry, but almost all of Ukraine, all of Turkey. So there's some significant world wheat production that's still in some areas of concern. And a lot like corn, you know, it looks like we're setting these seasonal patterns early. You know, that looks like a harvest time price drop off in the wheat market. If you look at what that July contract is doing relative to seasonal pattern, we didn't get that price rally in March, April, May that we normally get. We've just been falling lower and lower. Again, with the tariff turmoil, we're seeing a lot of speculative selling in the wheat market, just a lot of downward pressure, and it kind of looks like a harvest kind of low where we're headed to right now, which raises the question. We're going to be cutting some wheat here very, very quickly. When's the best time to sell wheat in Texas? It normally does not pay to store wheat in Texas. These areas that are highlighted by yellow would indicate the highest net cash wheat price for that year between June and January if you started paying storage in August. So I took the cash price, the average for the month, and then I took off a nickel a month for storage starting in the middle of August. So you got a nickel off, a dime, 15 cents, and so forth into January. When's the best time to sell wheat in Texas? Well, you can see we kind of lean pretty heavily to just selling it at harvest in June. That's typically your best price of the year. There's some good prices in there. There's some pretty crummy prices in there too. But many times they do not get better. July is kind of your, and then into August, that's kind of a cluster of your better selling periods. Now, there are some years when waiting later into the year, there's some really good pricing opportunities. And if you sold early, you would have missed some of those, but they don't come around very often. 2010 is a really good example of that. In June, we were looking at $3.55, horrible wheat basis in 2010. but that price got better in July, August, September. It just got better and better. And a $7 wheat price by the time we got to January. The Russian wheat crop got in trouble in 2010. We started hearing about that in July and August, and the wheat market just took off to the races at that point. But one feature of this chart, first of all, it does show that typically our best selling opportunities are around harvest. It usually does not pay to store wheat. However, if you do sell early and you miss out on these opportunities, you sold $5 wheat and you missed out on 8. You sold $3 wheat, you missed out on 7. You sold $4 wheat, you missed out on 5.60. $6 wheat, you missed out on 8. What happens to your wheat marketing opportunity the very next year? Okay, I missed out on that $8 wheat. What happened in 2008? I missed out on $7 wheat in 2010. What happened in 2011? I missed out on 5.60 wheat in 2020. What happened in 2021? The wheat market is given the global dynamics many times, those tight fundamental factors will carry over that drove that price rally in winter will carry over and give us good opportunities the next year. So yeah, maybe you miss it this time, but if we stay in the game, many times those opportunities will circle back around for us. And so that just shows again those months with the Texas highest Texas net cash wheat prices. Typically, they tend to cluster that June, July, and August. There can be some opportunities out there, but typically these are when the best opportunities will come around. Okay, that's all I had. Went through those a little bit quickly. If there's any questions, we can circle back on something, please let me know. Obviously, weather, the main factor out there, but this whole, the global economy, global trade, it's just a wet blanket, I think, on many of our commodity markets, from energies to our grain markets. Until we get some of that settled, we're going to have, I think, some tough sledding when it comes to building any price momentum. So, Pancho, appreciate you putting this together, and good to be with y'all this morning.
Mark, thank you very much. Any questions from Mark about wheat and grain markets? Well, David, whenever you want. Hope you're bringing better news.
Yeah, I got better news, I think. But I get to talk about cattle and some other things, and so yeah, I got better news than my colleagues. Although Mark, keep those corn prices low. It's good on the livestock side. Shoot, let's jump in. Like always, if you got questions, get them in the chat or say something or whatever. I'm going to start with prices, and I'm going to start on the cattle side. New record prices, calf prices, 500 to 600 pound number one steers. We actually hit $4. I didn't have the full data for the weekly average for last week yet, so my chart reflects 2 weeks ago, but incredible prices, really. This run over the last month or 6 weeks has been pretty great, continuing up to higher prices. So I had an extension program Friday afternoon, and of course the question was, how long is this going to go on? Are prices going to keep going up? Overall, the overall level of prices, I would argue, is going to be higher. We still got some room to grow, I think, to go up. But week to week, we're going to have variation and fluctuation like we always do. And so I think there's a good reason I'm going to get to in a minute as to what's supporting these prices and contributing to this little run we've had. So if we go from the calf market to fed cattle, we hit 224 as a 5 market average last week. That's an incredible price. I should say 2 weeks ago. Last week, we're going to come in a little bit higher than that, I think, for the week. If we look at late in the week, we were up another $2 or so in the cash market. So again, this really tremendous run over the last 4, 5, 6 weeks to higher prices. And I think we got 2 things working here, getting those prices to jump higher. And as I guess as a good economist, I ought to say it's going to be supply and demand. But let me point out something in terms of supplies. So we've got cattle on feed, and the next cattle on feed report will come out Friday. I expect placements to be below a year ago. Marketings were certainly below a year ago, and again, cattle on feed that are below where we were a year ago. But if we kind of take those numbers and calculate them out, what we can calculate is a number of cattle on feed less than 90 days. 90 days to 120 days, which is what I have here, and over 120 days. Now, we know over time we're feeding cattle for longer periods. And I think one of the things playing into this real run in prices is if we look at the number of cattle on feed that have been on feed less than 90 days and over 120 days, they're both higher than a year ago. So we got this window here of this 90 to 120 days, and we've actually had fewer numbers on feed in there. Now, historically, one of the things we would look for is when we see some big changes in this, either up or down, it gives you sort of an indicator. Are we current? Are we tight on numbers? Which is what this would suggest, is that we've had a little bit of a spot here where we've been just plain tighter on numbers. And so, we might say, well, why are marketings down? Why is daily slaughter down? We might, lots of times we say, well, we're slowing down on purpose to try to boost the cutout or to reduce the fed cattle price we're paying. If that was the case, we're not doing a very good job of it, because fed cattle prices keep going up. The cutout's gone up, but fed cattle prices have jumped even more than the cutout has. In this case, I think what I would argue and point out is I think we've had a bit of a hole here with just some tighter supplies. So given that now we're almost a little more than halfway through May, we've had tighter supplies of fed cattle ready to go. But it's also been grilling season, and we've benefited, particularly in April, from a run up in kind of that seasonal demand, switching over from kind of the wintertime cuts of beef that are popular to grilling season. And that means ground beef, it means steaks. And we've certainly in the wholesale market seen sharply higher prices on the higher end steak stuff. So we've got all of a sudden this little bit of a hole, and pretty great grilling season kicking off, and I think that's driven our prices higher. So keep in mind this idea of supplies. We know we've had dressed weights that have been incredibly large. We've actually seen some decline, and if we look at this red line, which is our 5-year average, we see a seasonal decline in weights before building. Last year we didn't get much of that seasonal decline. It was pretty flat. This year we've got some seasonal decline going on. I think this supports the idea of tighter supplies all of a sudden, because what we'd expect is if we need those animals, we need those cattle to head to a plant, we're going to pull them out earlier, which helps to pull weights down. Now, is this a 1 week little shift in weights, or is it the start of something a little more to some lower weights? I think that's pretty interesting, but still the overall level of weights is helping to make up for fewer cattle, but all of a sudden we've got this tight supply going on. If I had broken out and kept the chart, I had too dang many charts already. So I cut these out, but I had weekly steer slaughter and heifer slaughter, and you see both of those decline dramatically in the last 4 or 5 weeks, sharply lower slaughter. And we combine that with weights, and I drew a little black circle around these weeks. I wanted to point out is we've had a sharp decline in beef production relative to last year, even less than the 5-year average, even with weights above a year ago. And it's really, I think it gets to this idea that all of a sudden we've had some pretty tight supplies, and that's driven beef production down below sharp. I mean, that's a 7-8% decline in several of those weeks, year over year decline in beef production. So all of a sudden, boom, less production at grilling season, and we've driven these prices to those kinds of heights. Now, what we might expect is if we get past this little bit of a hole here, even though the overall level of cattle on feed numbers is below a year ago, we do have some opportunity to be boosting production a little bit in kind of the heat of the summer, as we often do, and then kind of back off those fed cattle prices a little bit from the heights they're at now. But still, overall, really less production, but it's really come to jump at us in the last 5 or 6 weeks with sharply less beef production. I think that's a big part of driving those prices higher. Less stuff and grilling season. Let me talk trade for a little bit. I've got here our weekly data on feeder cattle imports from Mexico. I think most of us are aware that we closed the border to Mexican feeder cattle a week ago Sunday, a week ago yesterday. The animals that were already there in the process are allowed to come in, so it hasn't dropped to zero yet. About 20,000 head for the week ending May 15th. But we will see those numbers to begin to decline. Again, this is all over fears of screwworms. They have had some more cases that are moving north in Mexico. They continue. The closest one they found, animal, cattle anyway, is still 700 miles away from us. But they've moved out of Chiapas to finding some in Veracruz, Tabasco, and Oaxaca states. Those are far southern Mexico, but they're moving north. And so, I think potentially in the program I did Friday, I talked about, what are risk factors? I think the biggest risk for cattle prices, I think, is demand and related to the overall economy and consumers, and do they have money in their pocket to spend? I think that's the number one thing. Trade is a source of volatility in terms of the beef side as well. But my third bullet on that slide was longer term from a production standpoint. I think this risk of screwworms is pretty darn important longer term out there. So we'll see that drop to zero. I think I wrote in our Southern Ag Today with a couple of colleagues last Tuesday, looking at these numbers. And if we look at how big are these feeder cattle imports from Mexico? Well, year in and year out, they amount to about 3.5% of our calf crop in the U.S. So if we take all the calves born, they're the equivalent about 3.5%, about 1.3 million head come in a year. But if we looked at on an annual basis, the number of cattle that we place in southwestern feedlots, and by Southwest, I took the data for Texas, Arizona, and California. And if you take that data over the last decade or so, the Mexican cattle imports are the equivalent of about 18% of our total placements per year. So the supplies of these numbers to the Southwest are particularly important for our feedlots. I think that's got some longer term implications just for our feedlot capacity, our capacity utilization, but moving on from there to our packing plant utilization. And we know with a smaller cow herd, fewer calves, fewer cattle on feed, that we got way more capacity than we have cattle. I think that has some particular risk implications for packing plants staying open and things like that throughout our sort of capacity. So we went from a few years ago about not enough packing plant capacity to now all of a sudden, particularly with this, way more than we need. And so I think there's some real risks and some kind of market fluctuations out there, kind of longer term going on. But I think this is worth noting, and I'll keep updating this chart, and we'll see that thing drop to zero in coming weeks as those cattle that were already in the border ports of entry in the pens there come through. So we'll start to see those decline pretty sharply. The other question I've been getting a lot, and this graph looks like a bowl of spaghetti or an Etch-a-Sketch or something, but particularly in the context of tariffs, what I've got here is our weekly exports of muscle cuts. Now, we export all the offals, we export hides, we export everything else. But if we're looking here at muscle cuts, I want to point out really three things here. That black and green line at the top, that is Japan and South Korea as our export markets. Those are consistently our largest two markets. The two at the bottom, the purple and blue, is Canada and Mexico. Mexico's the purple, Canada's the blue. Those are our weekly exports of beef to Canada and Mexico. So we sort of have this Asian market and our North American neighbors. But that fat red line that I stuck right there is China. And I've gone back to 2021, but if you look since 2021, China is consistently our third biggest market for exports. Now, we could go back a couple of years earlier and it was basically zero. And I should say, too, that this is mainland China. Because we also, in the data, we break out Hong Kong for some long-running data reasons. We break out Hong Kong so it's a little separate. But mainland China, that's our third largest export market. So what I want to show you now is I've taken off the other. These are our big 5 countries. I took those top 4 off the list, and I want to show you the impact of tariffs. We went from running about 2,500 metric tons of beef per week to China over the last several years, and that has dropped to 0. Last week it was 0. And so you can it's pretty easy to see the effect of these very large tariffs on our exports to that market. Now, if I dug through all the data and looked at the other countries, I'm going to go back to that slide before. We don't have a lot of effect here because the tariffs aren't to the magnitude of that, 145, 245%, whatever the number was, and then retrenching that. And now we're going to talk about it a bit. But we certainly see a rapid decline there. So it's our third largest market. Export market. We export, I'm going to give you some ballpark numbers. We export about 10% of our beef production per year, basically. And so we can think of this as being something like, and I didn't go calculate it out, 1%, 1.5%, 1.25%, something like that of the equivalent of our total beef production was going to this market. So I think that's a pretty striking chart. Really, we see some rapid effects of the tariffs on this particular market. We don't see a lot on the other markets, but I think that's really because of just plain the magnitude of the tariff there versus those other countries. So I think that's kind of interesting. Gives us some context of what we've been sending there and where we're at now. Let me say something about lamb. So there's about a 2-month lag in our monthly trade data. So I've got the trade data through March. I left the date on here, which was this data came out on May 7th. So about that first week of June, 7th, 8th, 9th, something like that, we'll get April. You'll notice we normally see higher imports in March. That's really driven by our Eastern religious holiday demand, and then our imports drop off. If we're going to see some impact in terms of the tariffs, we might see some effect in April, but more likely when we finally get that May data, we'll see some impact there if we're going to. So I've got weekly data on prices, so I can look at a U.S. price versus an Australia, New Zealand leg and rack prices. We don't see a whole lot of effect in changing those price relationships yet from the tariff imposition on Australia, New Zealand. Again, those tariffs are relatively small. They're 10%. But we don't see a lot of effect in the prices. I'm looking forward to seeing this data. If you're interested, particularly focused on lamb and wool, I did a podcast with Jake Thorne last week for the American Sheep Industry Association on tariffs. And it's the basics of tariffs and how they work, who pays, kind of from as an economist looking at tariffs and their effect, particularly in those two markets. Those lamb and wool markets do have some different directional effects, I think, of the tariffs that have been put on so far. I think that podcast is pretty good. So if you're into podcasts, it's the American Sheep Industry Association kind of monthly podcast, and our colleague Jake Thorne runs that thing. So I've actually gotten some pretty good comments from people back through email over the last week who have listened to it, and so it might be useful too if you got some folks who are interested, or yourself. So I'll put in a plug for that. Heck, if we're going to look at lamb prices, again, our 60 to 90 pound slaughter lamb prices, we had our sort of spring Easter run up. We got to about 280. We started coming down, seasonally there, and then got a really sharp rebound for a week or so in those lamb prices. Really, and I think really corresponding to production dramatically falling after Easter, as it usually does. But we've seen a pretty sharp decline in production. I think that's boosted our prices back up. If I had put a chart in here also, say heavyweight, more traditional heavyweight lambs, they're really going in a different direction from these from our lightweight slaughter lambs. Boy, in some of those markets, those heavy lambs have really declined after the holidays, whereas we've gotten a little support in the lightweight lambs. So really kind of a different direction going on there as well. But there's a good look at prices, and I don't usually do anything on goats. So I just did a chart of 40 to 60 pound number one kids and yearlings is our San Angelo market, and prices well above where we were a year ago. We had our little springtime run, headed into the holidays, but again, prices well above a year ago on the goat side as well. Pancho, that's my last slide. I'll see if I can end the show and maybe stop sharing. Here we go.
Excellent, David. Thank you
Anybody
very
got
much.
any questions? You know what? I didn't answer Mark's question. We talked about overall livestock numbers for feed use. Yeah. Smaller cow herd, fewer cattle on feed. Hogs, the only thing that's been boosting hog production is the number of pigs per litter. It's more productivity than it is growing the sow herd. We've really struggled there, I think, but we struggled with returns on the hog side for a couple of years. So I don't think we get much, we don't get a lot of help there. Although look at the futures market for hogs, we've had over $100 lately, back up to $100. That gets us back in the black, I think, on hog production. The chicken side, we've had a few more numbers, and we're feeding to heavier weights. So, if nothing else, maybe a little more corn use there, and we've got some more dairy cows. So I'm not sure any of those are dramatic increases in use from a numbers of livestock standpoint to kind of boost consumption.
Right. Let me stop recording.
Now we can say the good stuff. You're going to quit recording.